Hello traders. In this video podcast, I'd like to go over an important topic that I think every trader, when starting out, and even just intermediate traders, all the way up to very experienced traders that are trading with a lot of money, all go through. They all face this same problem, which is your emotion. When to get out of a trade and when to stay in a trade that you place. When you set a stop loss and a take profit, first of all, this should be somewhere around 1-to-1 money. Could be a little less, but ideally we want to keep it around 1-to-1 or better. 2-to-1, 3-to-1 money is ideal. But many traders, they don't follow their take profit. And what this does is it creates, from a mathematical standpoint, it creates their trading strategy to be flawed and not profitable. And let me give you an example of what I mean. First of all, the market is a living and breathing machine. There are millions of traders from around the world that are placing trades, getting in and out of trades at all times, every second of the day. And when trades are entered and exited, we like to say the market breathes. There's no such thing. There's never going to be just one straight line where a trade is going up or down. It breathes. It goes maybe up 10 pips in your favor, and then it might go down 5 pips, and then it might go back up 7 pips, and then back down 2 pips. It's breathing. It's breathing in and out as market conditions are happening in real time. Again, this is a live machine where people are putting in money and taking out money in real time around the world, and you are watching on your screen a Forex chart that reflects that. So when setting a stop loss, and for this example, let's use a 50 pip take profit and a 25 pip stop loss. So in this example, we have a 2-to-1 money ratio that we're after. And many traders will enter a trade and the trade goes positive and it goes up 5 to 10 pips. And then all of a sudden, that trade starts to reverse or turn around. And not an actual reverse, but the trade has gone up 10 pips. Right now it is 10 pips positive, but it starts to go the other way. And instinctively, traders look at that and they look from a mindset of, I've already made 10 pips. If I just close it now, I get to keep those 10 pips, or if it's reversing and it's at 7 pips or 8 pips, I can still be up 7 or 8 pips if I get out of this trade now. And many traders, new traders, intermediate traders, will close that trade right then and there and take that little profit off the top. And while this might look nice short term, what you're doing is you are hurting your overall trading strategy. And from a mathematical standpoint, if you have consistent, for this example, 25 pip stop losses on your trades, but the maximum that you're only winning could be 5 to 10 pips each time, you need to win 3 to 4 trades for every trade that you lose just to break even or get close to breaking even. Maybe a little bit of profit ahead depending on when you're taking those small incremental profits. And what you don't realize at the time of trading is when you take these small little profits, you are breaking the profitable money management system that you should have in place. When you take a trade and it immediately goes in the opposite direction that you think it is, many traders will allow that trade to go the full 25 pips for the sake of this example, which is fine. But if you just put those two together, you're taking the full stop loss that you're allotting, and you're only taking very small incremental take profits. So you have a broken trading strategy. And think of it like this. If trading is, and we made a previous video on this, trading is basically 50-50. There are other factors involved, and it's not that simple, but it's 50-50. A trade's going to go up or down. So if you have, at a starting point, roughly a 50-50 chance of a trade going up or down, depending on which way you're playing it, if you're consistently losing money because of money management or because of your trading style of taking very small incremental profits and letting your trades stop loss out for the full amount, this could be why, or this is why you're not making any money. And I want to say that this is a very common problem. I can't believe that any trader in their trading journey has not come across this. I know I certainly did when I started trading, and every single trader I've ever had this conversation with has had the same, more or less just internal conversation with themselves. They know that they shouldn't be doing it. They know that that it's wrong to take these very small incremental profits and let your stop loss go the full distance and never taking full take profits, that this is a losing strategy. You know deep down that it's not right, but psychologically, when you have emotion involved, emotionally our minds tell us to take what we have and don't lose anything that's been built up. And this is just a natural emotion, which is the wrong emotion. Once you get good at trading, once you're an intermediary or an expert trader, you will start to, as you've taken thousands and thousands of trades, you will start to realize that the market does breathe. It's always going to breathe. It's always going to be this big machine that is funded and used by so many traders around the world, and this is just part of it. Trades will go up and down and up and down, and preferably in the direction that you want it to go, and that's just how it is. It's never going to just go in one direction unless, of course, there's a news release and you reach your 50 pips within a few seconds. That would be the exception, but in normal trading circumstances, that isn't going to happen. It's going to breathe in and out until you reach your take profit or stop loss. Now, I want to address when the right time to get out of a trade is before your stop loss, and when a good time to get out of a trade before your take profit. So we intraday trade, so we are after 25 to 50 pips of a trade, and if you're working with a stop loss that is, let's say, 50 pips and you're intraday trading, our rule is that if you reach 20 pips positive, you reset your stop loss to break even. That is actually our rule. That is what works for our trading style, and it works very well. If we can get 20 pips out of a trade, and most of our trades are within that 25 to 50 pip range, if we get close to 50% of where we want to go, it's safe to say that it's either going to hit our take profit, and if it completely does a reversal, we've gone long enough where there's no reason to not take we don't want to lose any money at that point. So we'll break it even at stop loss. Now, some traders will take profit, right before break even, so they're making maybe just a little bit of money. But if it's going to go, if you're an intraday trader and it's going to go 20 pips, that's really a safe area in our trading style where you can take money off the top or get out of the trade or set it to break even at that point. If you're taking profit when you're up 5 pips or 10 pips and then it reverses back down to 5, it's not enough. There's not enough movement to know either way. And you should trust in your analysis. You should trust in the trade that you're in, if you're confident in it, to allow it to go the distance. So that would be the first example of when to get in a trade and not instantly out of a trade when you're trying to take profit from the standpoint of allowing it to go, not just a few pips, but let it go a decent amount. Let it go 50% of the way or 75% of the way before you consider getting out of that trade. Let's talk about when to get out of a trade when a trade is going the opposite direction before your stop loss. A really good indicator that gives you an idea would be the EMA, and you can use, or traders use, two EMAs, usually a larger and a smaller EMA depending on the time frame that you're trading. And when you see the two EMAs cross, if your time frame is let's say you're an intraday trader and you're after 50 pips, you could set your two EMAs to a 5-minute time frame. And if you see an absolute reversal where those EMAs cross, they are now opposite, one on top of each other, and it is clearly going in the wrong direction, this could be an immediate indication that your trade, you're just wrong in the trade, and you could get out of this trade early before your stop loss. This would be different than a trade gradually over time reversing, where it's not going to give you that immediate EMA cross. It's going to just allow that trade to slowly pace in the wrong direction that you have bet that it would go. So in this case, if you see just an immediate, on a higher time frame or a decent time frame, a 5-minute or a 15-minute time frame, where you just see that immediate cross where your moving averages are affected right off the bat, this could also be this could be a good sign that you've just made the wrong decision to enter that trade, and you could get out of that trade before your intended stop loss. So I hope that this video has just shed some light on money management and getting in and out of trades early, or when to let them go the distance. We spend a great deal of time in our videos, and most of our videos we're mentioning something about money management and why it's so important. And I invite anyone who has not listened to that video or videos to go and do that, because money management is really the prime determining factor on whether you're going to make money or not. Again, you can flip a coin, a trade's going to go up or down. There's more to it than that, but unless you have money management, unless you mathematically have the advantage where you put yourself in a situation to make money, if you're not doing that, it will be impossible for you to make money. So just as this video explains, psychologically, just don't let your emotions get in the way. And I know that that's easier said than done if you don't have a lot of trading experience or you haven't taken thousands of trades, but get out of the trade for the right reason. Take your profit early for the right reason. Don't just do it on impulse because you see that a little bit of money has been made and you want to just grab or grasp what you can, while allowing your stop losses to always go the full distance. This is not a winning strategy. You know deep down that it won't work and that you'll lose money, but still traders do it, and to the tune of 95% of traders that are losing money, many of them don't break out of this habit and continue to have either poor money management and or they don't have a mathematical savvy way of really making money. It is impossible to make money if you're taking profit at 3 to 5 pips or 10 pips on your take profits or less, and you've got really big, 25 or 50 pip stop losses. Even if you're breaking even on your wins and on your losses as far as how many you win versus how many you lose, the pips alone of what you're losing, you're losing way more pip than you're making, which would either force you to have to spend more than 1 to 2% per trade or just not put you in a good situation. As always, leave your comments below. We're always interested to hear what you guys have to say. Email us if you have any questions, and I hope this sheds some light on proper take profit and stop loss, getting in and out of trades, and just really breaking out of the mindset of that scarcity mindset, trying to take profit way too early and allowing your trades to go the distance. Because again, it's a moving, breathing machine. When you can get 50 pips on a take profit as opposed to 5 or 6, you're taking 10 trades of taking little incremental bits and pieces, scraps of profit, when just one trade that is that is set up correctly can go the distance and give you 5 or 10 trades worth of profit. Hope this finds you well. Take care, traders.